Hey guys, it's Serge here. Today I want to make the case for buying dips and selling rallies as opposed to holding something for a trend, or at least as an alternative strategy. And I can tell you empirically, for me, when I try to buy dips on confirmed oversold reactions and when I short into confirmed overbought territories, I actually tend to make much better returns or much better risk-adjusted returns than if I try to hold through an entire swing of a trend, so to speak. So most recent example here actually has been in bonds over the past couple days. What you have here is a 10-year Treasury note futures contract, and you can see it after a sell-off here over the past couple of weeks. We had a very nice bullish reversal on Thursday, so yesterday, Thursday, May 7th, and we're seeing follow-through buying today here after the jobs report. Now, what's important is you don't really want to buy blindly into a major event, but what we're seeing here is we actually had a confirmed bounce the day before the news came out. So today we're seeing follow-through buying after it was and we're confirming today's follow-through buying in retrospect by looking back at yesterday's trading action. So I'm going to zoom in a little bit more here, and you can see that bullish reversal here from Thursday, from yesterday, is now being the way I use it is I look back and say, okay, well, this capitulation move confirmed is in retrospect confirming today's follow-through move higher. So I think there's a decent chance of, excuse me, of going a little bit higher here. Now, assume there wasn't a jobs report this morning and this was a different asset, and it doesn't really matter what the asset. Let's say it was a stock, and the stock gave us this reversal after it came into the 200-day moving average, this red line that you can see here. Let's say that were to happen, basically, and guys have talked about this, anyone from Tudor Jones, major hedge fund player, to other guys, and again, I've empirically experienced this as well over my career, that I tend to get much better risk-adjusted returns if I try to buy into dips that have been confirmed as oversold. I don't want to blindly buy and sort of, cash the proverbial knife, but I'm seeing, but I have a confirmation in place where there's even, let's say, confluence support area where multiple things are coming together. In this case, we had that. We had lateral support. We had the 200-day moving average. All these things come into place in this asset. Again, assume this is not the 10-year Treasury. Assume this is whatever asset it was. So we had a pretty darn good risk reward going long yesterday against the intraday lows yesterday. This is a basic bullish reversal move, but if you can keep it in context and think about it, you have very defined risk right away. You can get out at this level down here, yesterday's intraday lows. That is your risk. If it drops below there for more than, say, 15, 30 minutes, whatever your time frame might be, you get out. You don't have that in the middle of a trend. So like anywhere in here, we just didn't have that. That risk reward is nowhere as good because we didn't get into a confluence support area where we had a dramatic bullish reversal, right? So that's something I wanted to go through today. I think it's extremely important when it comes to risk reward. People say don't try to catch the knife. I agree, but if you get if you keep this in context and you buy when there's confluence support and clearly oversold territories, or measurements in oversold readings, then basically you have a really good risk reward to go long a stock, and the same thing happens when a stock is overbought. So I hope this makes sense, guys. If you like this video, please like it. Otherwise, if you've got questions, you can hit me up on Twitter. My Twitter handle is SteadyTrader, and make sure to go over to SteadyTrader.com and see what we're doing over there. Take care, and I'll see you in the next video.